Welcome to this month's Big Picture episode of the Michael Yardney podcast, where Pete Wargent and I dissect the multitude of macroeconomic factors currently shaping our housing markets and the broader economy. Now, being the first Big Picture podcast for the new year, I want to look at the clues in the news for what's ahead for our economy and our housing markets in 2024. And whether you're an investor, a homeowner, or just a curious mind, these regular monthly deep dive episodes I have with Pete Wargent are going to keep you informed, keep you ahead of the curve. So, without further ado, let's dive right into our conversation with Pete Wargent.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment, and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
In these regular Big Picture podcasts, Pete Wargent and I discuss the macroeconomic factors affecting our economy and our property markets. And as usual, there's lots of news since our last chat. So I'm delighted to have Pete Wargent join us again as one of Australia's most respected financial analysts and a commentator. Pete brings his invaluable expertise, and it's going to help us again navigate the ever-changing landscape and give us some clues as to what's ahead for our economy and property markets for 2024. Hi, Pete.
Hello, Michael. Always great to be on. Looking forward to it.
Well, Pete, we were just chatting before about the year that's gone, 2023, and I think one of the lessons I learned from it, maybe relearned is a better lesson, is investors were right to ignore all those dire warnings, all those pessimistic property forecasts that started last year, 2023, and finished off 2022.
They did. So, yeah, it seems like a long time ago now, doesn't it? I think if you think back to the start of 2023, you had financial markets were pricing in for a whole salvo of interest rate hikes. And the general view at the time was, well, this is going to be very negative for real estate. And look, it has been in some senses. It's been very negative for developers.
Yes.
It's been really a negative for construction. So we're only building or completing about 40,000 dwellings a quarter at the moment, but that's against record high population growth. So it's had an impact, but not necessarily in the way people thought. And as you said, if you sat on the sidelines, well, you'd be paying quite a lot more today as a result. So yes, didn't play out as expected. Interest rates actually went a bit further and a bit higher than might have been expected at the beginning of the year, but it hasn't had the impact on prices that you might have expected.
Well, when we chatted, as we regularly did last year, we didn't see a market downturn. We saw the leading indicators of higher asking prices, reasonably strong auction clearance results at the beginning of the year, lack of supply at the time that there was increasing demand, as I guess the tailwinds to actually rise property values in 2023. But to be blunt, I really didn't expect double-digit growth in Sydney, Brisbane and Perth, the big capitals. And I didn't really think Melbourne would be such an underperformer. There was quite a variety of markets. There always is. I guess that's one of the lessons also, that there isn't one Australian property market. And even though Melbourne in general did around 3.5% over the year, there's not one Melbourne property market. Some segments did much better than others, Pete.
Of course, it goes to show, I guess, the perils of trying to time the market to that level of precision. Of course, we all try to do it to the best of our ability, but over short time frames, it's difficult. And as you said, I think actually, and there's been a real dichotomy in the market this year. There's certainly some property types have been in red hot demand, others not so much. I think there's a bit of a reversal going on. I think the capital cities coming back into focus because I think during the pandemic, there was a general shift outwards, the race for space, but that's reversing now. I think a lot of people are back in the office. It seems 3 days a week, but not necessarily 5. And a few.
That seems to be the new norm now, doesn't it? 3 days a week, Pete.
It's going that way. I mean, at one stage we had, about 40% of employees were working from home. The numbers are going back towards the pre-pandemic level.
We're spoiling the statistics, aren't we? Both you and I work from home all the time.
Well, that's right. But it seems that people are still in the office say 3 days seems to be the new normal. Now, some firms are trying to tie bonuses and promotions to office attendance. So, but at the moment anyway, unemployment's still under 4%. So the balance of power is still very much in favour of the employee at the moment. But I think that actually changes in 2024. If you look at expectations for the unemployment rate, probably 4.5% by the middle of the year. Next year, maybe higher, maybe gets towards 5%. That's when the employers get the upper hand again. So it'll be interesting to see. Generally, the trend is back to the office, but not back to pre-pandemic levels, not anywhere near there yet.
So all this is, again, pointing out that we're moving back to the big capital cities. And when we look at the population statistics, maybe we'll have a bit of a chat about that later, there is a trend back to the capital cities. But let's do a spoiler alert. I think 2024 is going to defy the property doomsayers again, because they are out there. I mean, at this time last year, it was the Reserve Bank, it was all the big banks, economists, and some quite prominent independent economists who suggested the property market was going to drop 10, 15, 20%. The banks have all changed their forecasts. So I don't think we should be listening to all those forecasts in the media anyway. Let's just look at the fundamentals, which we're about to. But it's the same people out again saying that interest rates, which are going to remain higher for longer, are going to be one of the factors affecting our markets. I think we realised last year that really isn't a major factor. Sure, it affects consumer confidence, it affects the way you can pay for your mortgage, but interest rates didn't slow the markets down.
Hardly at all. If anything, the prices and activity picked up as the year went on, I think, as people got a sense that we're getting closer to the peak of the cycle. I think, for 2024, it's just supply and demand. There's nowhere near enough dwellings being built. Population growth is running at all-time highs, and there's a shortage of property on virtually every metric. Rental vacancies are at record lows. We're not building anything like quickly enough for the population growth. Stock listings are still way down on the 5-year average. Not enough new builds for sale. Building approvals are at decade lows. Everything is pointing to shortage, and these things are always cyclical, but yes, we're not going to be building enough probably for the next 3 years, I guess. I mean, I think in 2026, you start to see some of that build to rent stock come on and whatnot, but for the foreseeable future, shortage is the key word.
I think it is. And the building industry is in crisis. Developers are not keen to start those new developments, as we've said a few times. The surging population, there's a undersupply. There's various estimates that already we're starting with 120,000 undersupply of dwellings, and we're just not keeping up. So it's going to be undersupplied for years. The last big boom when we developed a lot of properties was the high-rise boom a couple of years ago. At the moment, it's just too expensive to build new high-rise developments, and there aren't enough workers either. They're being pulled off to a lot of the infrastructure projects. But building more high-rise apartments is one of the ways the federal government's hoping that we're going to build that 1.2 million dwellings they're looking for in the next 5 years, more medium density, more high-rise. But the soaring cost of materials, the construction industry, crisis, trade shortages mean that they're going to have to bring new properties onto the market at much higher prices than today. So I guess my conclusion from that, Pete, is two things. Number one, there's inherent equity in established apartments because new apartments are going to have to cost that much more. And eventually, established apartments are going to have to increase in price before new ones can actually come out of the ground, before people are going to buy them off the plan. That's the average apartment. I think there's a bit of money to be made in the downsizer, right-sizer luxury market, but not in the bulk where the government's hoping for us to build a lot of dwellings.
Indeed, some really key points there. So, yes, construction insolvencies are at decade highs and they're still rising even now. So developers are naturally going to be very risk averse at the moment. Yes, on the cost side of things, building materials, very, very high. I think the rate of inflation has come down, but even still So
the rate of cost of construction has come down, yes.
Well, you guys are in the business, so I don't need to tell you.
It's suggested now that the cost of construction is increasing at about 8% per annum. So the rate of growth of construction costs has come down, but the cost of construction is still increasing, and it's not going to come down. It's never going to get cheaper. Materials aren't going to get cheaper, and trades, they're not going to accept less money. There's a shortage of skilled tradespeople.
I think trades costs are still going to go up in 2024. As you said, these things tend to be quite sticky. They go up, but they don't seem to come back down. If you look at a graph of construction costs for a new dwelling going back over 50, 60 years, outpacing inflation over all that time. Yes, you would think with improvements in techniques, it might come down, but actually what people want has improved. The cost of labour has gone up. I think so. The government's got this plan to build 1.2 million new dwellings in 5 years, which would almost by definition would have to involve a lot of medium and high-rise apartments, which is the only way they can really go about addressing that shortage. But really, this is just an announcement. There's not much around it.
Well, the government's not going to build them either. They've got to encourage private developers to build them.
At what price?
Yeah.
And who's going to buy them? I think, yes, you said that the previous construction boom was really driven by offshore buyers, largely from mainland China, but that's not really happening this time around. I think there are foreign buyers coming back into the market, but they're more interested in houses, particularly this time, or sometimes more premium property types, certainly higher up the price scales. Yeah, with the stamp duty surcharges, no, it's just not as attractive for Chinese buyers. Plus, I guess geopolitical relations aren't as good as they were probably if you went back to that time. So there's real issues here. The cost of delivering medium density stock is up by about 50% or more since pre-COVID levels. So yes, you're right. Prices are going to have to be higher. I don't know about Melbourne, you could probably shed some light, but what I've seen in Sydney and Brisbane is, yes, sometimes you can get these new developments approved at the premium end if you've got a nice water view or some kind of unique aspect, but the average development's just not getting out of the ground, and that's where the undersupply is going to come from.
Now, remember, most developers, to get funding from the banks, have to have a number of pre-sales. The banks aren't prepared to take their risk. Now, Harry Triguboff provides his own finance merit, and even they're not building at the moment. So who's going to buy them? That's a point you made a moment ago. I think most Australians now recognise that off-the-plan apartments are poor investments. There was just a really bad history that a lot of the off-the-plan high-rise towers built last time round are going to be the slums of the future. There's building issues with those. So all new construction is going to have to be built better. They're going to have better floor plans. Locals aren't buying them and foreigners are not. And in the past, a lot of investors bought them, but the investors are shying away as well. So, Pete, while the government has made it harder for foreign investors to buy property with increased fees more than locals, and there's lots of talk about foreign investors pushing out the local investors and home buyers, when in fact there's probably only about 3% of all transactions come from foreigners, but at the same time, the government's actually been cutting application fees for foreign investment in the build-to-rent sector. It's trying to encourage foreign investors, foreign developers to come back to the markets.
They are. So the Labour government's quite keen on this idea of build-to-rent. So if you're not familiar, this is something that's been quite popular in London over recent years, where a lot of the new stock is actually not built to be sold, it's built to be rented out. So corporations renting out. Now, it sounds good on paper, but of course, companies don't do this for altruistic reasons. They do it to make money from the rent. So the rents are usually going to be higher than what you'd pay in another rental. Now, some people would prefer to deal with a corporate landlord rather than, say, a mum and dad investor, for example. So there are some sort of potential benefits. And what we may well see is some foreign developers teaming up with local developers like Lend-Lease are doing in Melbourne with an overseas-based developer, and they can build some sort of tower blocks in around Flinders Street or the Melbourne Quarter or those kind of areas. But those properties are never going to be for sale, so they don't necessarily impact the for-sale market. They might take some of the stress out of the rental market. Yeah, a lot of this stuff takes probably until 2026 to come to market. So there's a long period between now and then. Now, in the meantime, we've seen building completions, they've dropped from about 60,000 a quarter to about 40, and they're still falling. So, and that's at a time when the population growth is going, well, in a quarter, it's about 180,000. We're way short. So, yeah, it's an emerging problem that's not going to be met, I suppose, for the next few years?
Well, one of the ways the government's hoping to release more properties on the rental market is they're actually going to levy foreign investors with a substantial increase in what they're calling a vacancy tax if properties are left vacant for more than 6 months, which is something you and I wouldn't consider. We wouldn't buy an investment property and leave it vacant, but a lot of foreigners and Chinese investors in particular do that. I guess they've done it here to bring their money out of the country, and they like the idea of a nice new clean property, but they're going to be substantially increasing the levy if people leave properties vacant. And the thought is it could bring a couple of 100,000 or at least 100,000 new properties that are sitting vacant on the rental pool. I'm not sure that's actually going to work.
It's a populist move, and it sounds like a good idea in theory, but in practice, I mean, is it actually going to bring any extra properties to the market? Maybe a few, but that's a bit of a fig leaf policy, and I don't think it's going to change too much. It's almost seen to be doing something at a time when we've seen, it's like the Hunger Games out there sometimes. If a good rental comes onto the market, there's people queuing out the door at the moment. So the government knows it has to be seen to be doing something, but I'm not sure that's it.
Well, yes, the government's trying all sorts of things other than encouraging local investors. If they brought more certainty to the playing field, we wouldn't be having so many investors leaving the market. And one of the things we keep mentioning is how much our population is growing. The latest Australian Bureau of Statistics figures showed that our population grew by 2.4%. Pete, this is back to those boom rates of the 1950s, a record 500,000 plus net influx of foreign students, workers and permanent settlers came. And then we've got the local growth as well. So our population grew by 624,100 people in the year to June, the financial year. Just putting that into perspective, because it's hard when you've got those big numbers. It's like adding 1.5 Canberras to our population. But that requires not just the accommodation, which we're not supplying, but the services, the infrastructure, the schools. So it's not just the roads and transport, but all the soft infrastructure, the hospitals, the medical care.
It's one of the challenges at the moment is that there's only so much capacity in the economy to build. And we've got some major infrastructure projects underway all around the country. So that's taking quite a lot of the capacity away. And as you say, population growth, 2.4%. It sounds like a lot, but it's 2.4% on top of a 26 million population at the start of 2023, or just a little bit higher. So yeah, that in absolute numbers comes to 624,000 for the financial year. So the Australian population clock will tick over 27 million.
Yes.
Around about January or February in the new year. That's the best estimate anyway. So big, huge growth. If you look, Western Australia has grown at over 3%. Over the 2023 financial year. And if you're looking at absolute numbers, well, Victoria is about 180,000, New South Wales, 170, Queensland, 135. They're massive numbers, and we just can't build for that. Now, I think if you look around the world, that we're starting to see some pressures. So the US government has issues with border control being a political issue. Prime Minister Trudeau in Canada is getting pushback against record population growth. We've seen a government change in New Zealand. Prime Minister Sunak in the UK has promised to cut migration by a few 100,000, also from record highs. All of those countries are facing similar issues, and they're promising to cut immigration. Now, Australia's government has already said, we're going to make some tweaks. We're going to crack down on foreign students, what they call the sort of shadow universities, where people are coming for education purposes, but also working potentially. And they might cut back on post-graduation work rights a little bit, but at the same time, fast-tracking the skilled visa cohort, the people that earn 135,000 plus. So again, population growth will naturally slow from 624,000 because it just can't continue at that level. But the government, it's a bit like with the inflation figures, they're not really coming down as such. The population's still growing, just not quite as quickly.
Well, if you think about it, this was a net immigration surplus because we didn't have people leaving the country. The students who would normally have done the couple of years here and leaving, well, they didn't come over the COVID period. So there was going to be a natural fall off in the net migration of students and temporary visas. But Pete, we needed those. I just remember a couple of years ago, every restaurant I'd go to down here, every bar would have a sign up wanting baristas, wanting wait staff, wanting people working for them. That seems to have gone now. But despite the fact that hundreds of thousands of people have arrived and at working age, unemployment figures have only just crept up a little bit. I think the Reserve Bank would have liked them to go a little bit higher to quell inflation a bit more.
3.9%, but I think if you look at a lot of the leading indicators, they're pointing to higher unemployment ahead. Well, they definitely are. Also, just some of the other measures of the labour market. So underutilisation has increased quite significantly over 18 months now. If you look at hours worked, well, that peaked a long time ago. There's certain measures that Jobs and Skills Australia put out in terms of difficulty of hiring. And as you mentioned, July 2022, I can remember exactly the same thing, walking down the strip at Mooloolaba thinking, wow, imagine being a backpacker. You could walk into any one of these cafes, work as a chef, work as a barista. There was some places advertising for multiple roles and all the shops as well. But that's gone away now. It's really been an 18-month process to bring that into balance. But the working holiday makers are back. We've got tourists again. We've got international students, some of whom work in the holidays and during term time. So unemployment's 3.9, up from about 3.5%. When these things start to rise, they can do so quite quickly. And 4.5% by June is the sort of the forecast or the expectation.
Yeah, but a couple of years ago, Pete, if you would have said unemployment was going to drop to 4.5%, the economists, the banks, the Reserve Bank would have been thrilled with that sort of figure. Remember, at the beginning of COVID, there was talk about double-digit, 10, 11% unemployment. Never got there, of course.
Well, yes, and in fact, at one stage in the US, we were talking about unemployment potentially rising to 25%. It's absolutely eye-watering to even think about. So, I mean, yes, people have obviously had some angst about interest rates, but when you think about where things might have gone, if the pandemic had played out to be even more severe than it was, or if we had to stay in lockdown for longer, or we didn't have the vaccines available, I mean, who knows where things could have gone? And we're talking about 3.9% unemployment being a deterioration. It's pretty incredible, really. Now, yeah, I think the interesting thing was sort of pre-pandemic, we spent years and years talking about we need to get wages growth to rise, and that can bring inflation back up to 2%. So it seems funny now because we've seen the inflation take off, but it wasn't really wages that caused it. It was supply chains. It was the closing of the borders, interruption of the global supply chains. And when inflation took off, then wages followed. So it wasn't the wage price spiral. It was the other way around. It was really a price wages spiral. So some important lessons there. And I think as well, it kind of shows that interest rates, they were only effective to a certain degree. And actually what has really worked is giving people money. Fiscal policy is what gets people spending.
Definitely. Now, it's interesting because you and I have been around the block a few times. We've seen the patterns while a lot of other people just see chaos there. And I think that's one of the reasons I love having a chat with you, because you've got not just the local perspective, but the international perspective as well, because you come, obviously with your accent, people can tell you come from overseas, but you also spend a lot of time there and you study what's happening overseas. And so I guess you've got to be careful who you listen to. I know one of the things that you and I have enjoyed every year is actually getting together on the Gold Coast Wealth Retreat, where we actually get together with a group of people who similarly have had years of experience and understand how to simplify all the confusing mixed messages. And we're looking forward again at the end of April 2024 this year to meet on the Gold Coast. And if people are just listening to this and interested and want to get into a room, if you want to have this sort of conversation, because you can listen to it on podcasts, you can watch YouTube videos, you can read Pete's blog and my blog, but Pete, there's nothing like actually sitting in the room and having breakfast, lunch and dinner with people and talking this sort of stuff, is there?
Well, the proof is in the pudding. I always lose track, but I think this must be my 8th year of Wealth Retreats. If it's either the 7th or the 9th or the 8th, but I've been going every single year, and I just wouldn't do that. I wouldn't take the time out of my schedule if it wasn't worth it. So yeah, I guess that's the best endorsement I can give it. But
Well, you always sit at the back and still take notes and still plan your year, as does Simon Kirstenmacher, and Andrew Wilson's going to be there, and a few new people in the faculty as well, including Stuart Weems is going to be giving a presentation on finance. So we're looking forward to it. But it's actually not just the faculty, is it? It's the people that are there that one learns from.
Absolutely. And if Weemsy is coming, then that's a huge draw card for me, because I always enjoy his content. And I think one of the things I find most useful is just getting clarity on what we might call the big, hairy, audacious goals. I set some massive goals for the next year. I get myself an accountability partner last year, Mark Creedon, for me, and to hold me accountable to actually doing what I'm saying I'm going to do. And I've been doing that year in, year out at Wealth Retreat. And it's actually amazing when you look back how far you come over, when you look back 7-8 years ago, and you can see the leaps and bounds that you've made in your personal development, your finances, your investments. I mean, it's worth every cent and more.
Sure. So even if you're listening to this and you're keen to join us at Wealth Retreat 2024, go to wealthretreat.com.au. I'll leave a link in the show notes. Don't count yourself out. By the way, you can't book in. I speak with everybody who joins us at Wealth Retreat to make sure it's right for you. And if I do, I'm actually happy to back it by my personal guarantee, and I'm happy to do that because nobody's ever taken me up on that. So why don't you put me to the test as well? Go to wealthretreat.com.au, find out about the discussion points. Again, it's something that's got a long track record now. So we started in 2007, so look forward to catching up with you there, Pete. But one of the things we've discussed every time we get together in these big picture podcasts is inflation. Well, we did it over the last year, I guess, anyway. But there's more signs now that inflation is cooling in Australia and expected to do so. There's good news with a lot of the international trends as well as some of the local economic factors, and that's going to be good for interest rates in the medium term also, isn't it?
Definitely is. I think if you went back to early October with the renewed geopolitical shocks and conflict, there was a lot of concern about what might happen to, for example, oil prices. Was there going to be another shock there? Well, it just hasn't happened. If anything, the US has been producing oil at a furious pace, quietly, I think, because it doesn't really go hand in hand with their sort of climate-friendly policies, if you like. But yeah, the price of oil actually fell very significantly, nearly 30%, and that flows through to the costs of production, but also petrol prices, which I suppose is the most visible sign when you're driving around day in, day out of what's happening to inflation. So there's been some various sort of big factors like that which have swung the right way. And if you look around the world, a lot of countries like Canada, the US, inflation's back to about 3% and falling. But the big thing that changed towards the end of 2023 is that the Federal Reserve finally has just pivoted, and it was pretty clear cut. They're basically done with hiking interest rates. Now the conversation turns to, when is the first cut going to be? Is it going to be in March or April? Markets are pricing for the US 6 interest rate cuts. I don't know if we'll get that many. That's a lot of cuts over the next year or so. And also for Australia. So market pricing.
Well, the case is now there for no more rises in Australia. The case is building for no more interest rate
completely,
rises.
Yeah. So I think whether or not we get one more hike will really just be dependent on the inflation figures. So I think the Reserve Bank has got 1% penciled in for the final quarter of 2023. So it would take something quite a lot higher than that to force another hike. I think if you look at what market economists are expecting, probably under 1%. So on that basis, there will be no more hikes. I think market pricing has actually been more accurate than the economists over the past couple of years. And if you take what markets are looking for, I guess, look, if you went through over the next 18 months, the timing's never clear on these things, but the markets are looking for a few interest rate cuts over 18 months. I don't necessarily know that the quantum is that important. I think the most important thing for people is clarity that the cost of borrowing is going down, not up. I think that's really going to be the big shift in mentality, because it's been an excruciating year or 15 months, I guess, of hikes. And people will be very relieved to see things coming down the other side.
Well, when you look at the case for interest rate rights, the GDP was low the last time the figures came out, 2.1%. In other words, our economy is not growing as fast. Seems like the savings buffers that we went into the last couple of years with after COVID have been eroded now. And that's what got a lot of people through paying their mortgages and still spending. And real wages growth, even though it's growing, real wages growth after inflation is still negative. The overseas factors and oil as being one of the big ones that you said. So I hope that the case for no more rises is going to be the way that the Reserve Bank goes when they meet in February. But there's going to be the monthly and the quarterly CPI figures come out in the month of January. So I guess that's going to be the big factors that they're going to take into account, Pete.
31st of January is the big one, which is the quarterly inflation figures for the December 2023 quarter. That's the make or break decision. I think it would have to be quite an outsized upside surprise to see another hike. I think if you look at the rhetoric that's coming from the Reserve Bank, of course, they're still sort of quite hawkish in terms of the commentary, but they don't want to go further unless they have to. And if you look around the world, inflation has actually been coming down faster than expected. New Zealand, it seems to be the case. United Kingdom, inflation suddenly falling and interest rates are falling. If you look at their gilt yields over there. So I think Australia will probably follow those trends. It's been a really interesting case study over the past couple of years, how all of those countries, with all of their different policies and everything else, well, inflation just went up and it came back down. And you can argue how much interest rates had a role to play in that and how much it would have happened anyway. But I think with unemployment trending higher, and the economy gradually softening, we've probably seen the end of the hikes if there isn't one more. And if you were to look 12, 18 months out, we're probably coming down the other side then.
Well, I remember seeing a chart at the end of last year which showed how long it was on average in Australia, looking back over the last 50 years from when interest rates peaked until when the Reserve Bank started dropping them. And on average, it was around 10 months from the peak. I guess they're going to want to wait to make sure that inflation's under control, that the economy is slowing, but not slowing too much. So that's that getting the right balance. But I think it's also important to remind people that we're not expecting interest rates to drop 2-3%, anything like they went up, are we? It's really going to find that Goldilocks figure in the middle where it's not enough to stimulate the economy too much, but not too high to cause a recession or slow us down. That's going to be an interesting exercise for the Reserve Bank.
Well, it's a really interesting question. What is the neutral rate for the cash rate target in Australia? Now, there's all different models out there. There's a range of them. If you take the best of them and average them out, they sort of point to about 1% being the real neutral rate. So if we've got an inflation target of 2 to 3%, so the implied target of 2.5%. Well, that suggests that a neutral cash rate, and this could be wrong, like it's one of those things like getting towards the horizon. The nearer you get to it, it can kind of move away from you. But it's to sort of suggest 3.5%, and we're at 4.35 today. So that suggests that the current setting should be slowing inflation, slowing the economy, probably rising unemployment, and all of those things are happening. So that sort of points to, yes, interest rates might fall from 4.35 to somewhere around the mid threes. That's reasonable. But I don't know, history has shown that when interest rates start falling, they can fall quite quickly. So we could definitely see an overshoot.
It also sounds like APRA, or I hope that APRA now starts to step in and decide, well, they don't need that 3% buffer on top of interest rates in a stable or falling interest rate environment, and that's going to increase serviceability. So A, serviceability will increase, B, wages are going to go up. But I think one of the big things that's going to happen in 2024 this year is that confidence is going, well, I hope, but I believe, is going to return as we see more stability in our economy and our interest rates. And when people have certainty, when their confidence improves, they make big decisions like buying homes or buying investments.
That's a really interesting question, the 3 percentage points lending assessment buffer. So it made sense to introduce the extraordinary buffer when the cash rate target was 10 basis points, basically zero, because interest rates were clearly going to go up and they could go up quite sharply from there, which they did. Why we've now got a 3 percentage points buffer at a time when construction is way short of where it needs to be, And interest rates, if you look at the curve, are going to fall. So it doesn't make any sense. I think, though, in reality, what's happening is that the Council of Financial Regulators will meet and they say, well, let's just hold this buffer in place as long as we can to help the RBA get its inflation rate back down to target as quickly as possible. They're trying to lend a helping hand, and they don't want to ignite a load of property investor speculation and potentially kick off any sort of more exuberance in the economy until they're sure that the battle with inflation has been won. But yeah, I mean, it doesn't really make sense. Why are we stress testing people for 10% mortgage rates they're not going to get? It unnecessarily shuts people out of the market, particularly first home buyers. And as you said, a lot of investors are actually selling, even with the lowest rental vacancy rates on record, about 0.8%.
Well, we've covered a lot today, and I look forward to our monthly big picture chats throughout the year. I think there is going to be the same themes: what's happening to the economy, what's happening to interest rates, inflation. But I guess the purpose of this is not just to talk about where, like a lot of other podcasts, where the next hotspot is or what to buy, but really talking about the factors, the multiple factors affecting our economy and our housing markets. I love the insight you're bringing. Now, you also bring it in your daily blog and with all your tweets on, are they still called tweets on X? What used to be called Twitter? Well, whatever.
I think so.
Pete, so how do people keep in contact with you, Pete, in between these sessions?
Well, Pete Wargent Blogspot is my daily blog, at Pete Wargent on Twitter. But I can tell you the best place, if you want to catch up, is at the Wealth Retreat, because to have a week of time there where I can speak to everybody face to face, and yeah, we can do a lot of stuff remotely these days, but it's never quite the same as meeting people in person. So get your tickets and I'll see you at the Gold Coast.
Well, that's actually one of the interesting things that happens at Wealth Retreat. There is time to sit face to face with the faculty and speak and discuss your personal questions. And Pete, you've been around long enough to know there's nothing to sell at the back of the room. We don't ever sell anything, properties, courses, appointments, whatever. So wealthretreat.com.au. And Pete, look forward to catching up with you again in a month. Let's make 2024 a great year.
Thanks, Michael. Look forward to it. Cheers.
I hope you got some benefit from my chat with Pete. And if you did, and you don't currently follow or subscribe to this podcast, hey, for a sec, just stop. And whichever podcast app you're listening to this on, just follow the show so that twice a week you get the thoughts of my regular experts and me as we help you understand and unpack what's happening in our property markets. Now, we're into 2024, aren't we? So I want to just ask you a question. Are you satisfied with where 2023 took you? Did it bring you closer to your property investment or your financial freedom goals? Or maybe it's possible the banks have actually made things harder for you, as they did for many investors, or maybe you're just stuck struggling to make sense of all the conflicting messages in the media. Or maybe you just weren't sure if the timing was right. Well, no matter where 2023 took you, if you're a home buyer or a property investor, as your mentor, and I hope I am mentoring you and helping you along in your journey, my question to you is, what are you going to do differently in 2024? Because our housing markets are going to be very, very different this year to last year. You've already just heard that in our discussion. So if you'd like to prepare yourself and get growth, because there are still some areas where things are going to go well, if you want to uncover your next steps, I want to invite you to have a complimentary wealth discovery call with one of the wealth strategists at Metropole. Just go to metropole.com.au and we're going to be in contact with you. Now, if you've been a follower of my podcast, you know that the multi-award winning team at Metropole are much more than just buyer's agents. We help our clients safely grow intergenerational wealth through property. We're big enough to tip the scales in your favour, but still small enough to care. So whether you're just getting started or want to grow your existing portfolio, we've got a range of services that could help you. Go to metropole.com.au. You can actually find out about our time-tested system, ones I've fine-tuned over 5 decades that our team are going to help you with by putting together a strategic property plan, or you can find out about our wealth advisory service, property management, renovations, development, and mastermind business accelerator with Mark Creedon. Metropole.com.au. Let's make 2024 a great year.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
Many years ago, my mentor, Jim Rohn, taught me that life is worthwhile if you use 4 powerful little words. These words are learn, try, stay, and care. What a difference you can make to your life by putting these words to work. Jim Rohn taught me that, first of all, life is worthwhile if you learn. If you know, what you don't know will actually hurt you rather than what they often say, what you don't know won't hurt you. You have to have learning to exist, to grow, to succeed. Life is worthwhile if you learn from your own experiences, both negative and positive. We learn to do it right by doing something wrong the first time. We call that a positive negative. We also learn from other people's experiences, both positives and negatives. Jim Rohn always said it was too bad that failures don't give seminars. He said we don't want to pay them so they don't go on tour and give seminars, but the information they would give you would be very valuable. How somebody who had it all messed up. Learning from other people's experiences and mistakes would be very valuable. We learn by what we see, so pay attention. By what we hear, so be a good listener. Now, I suggest, though, you become a selective listener. Don't just listen to anybody dump into your mental factory. We learn also from what we read. Learn from every source that you can. Learn from podcasts, learn from lectures, learn from conversations, learn from people who care. So I guess the first part of this lesson is always keep learning. It's one of the rich habits, the success habits of all wealthy people. Jim Rohn then went on to say, life is worthwhile if you try. Remember, he said there were 4 really powerful little words: learn, try, stay, and care. So life is worthwhile if you try. It doesn't mean you can do everything, but there are a lot of things you can do if you just gave them a try. So try your best. Give it every effort. Why not go all out and give it a go? Jim Rohn also said life's worthwhile if you stay. You have to stay from spring to harvest, he said. From the beginning to the end when you reap the rewards, I guess is what he was saying. So if you've signed up for the day or for the game or for the project, see it through. Sometimes calamity comes and it looks like it's worth just wrapping it up, but that's not the end. It's only the middle. Maybe the next project will be better, so stay on this one. If you signed up, see it through. And that is definitely one of the success traits of the wealthy people, the successful people, the rich habits. They actually stick to it, they see it through. Remember, Jim Rohn was teaching us about 4 powerful words: learn, try, stay, and the last one was care. He said life is worthwhile if you care. If you care at all, you're going to get some results. If you care enough, you're going to get incredible results, he said. Care enough to make a difference. Care enough to turn somebody around. Care enough to start a new enterprise. Care enough to change it all. Care enough to become the highest producer. Care enough to set some records. Care enough to win. Some great words from the late Jim Rohn. Life is worthwhile if you put these 4 words to use. Learn, try, stay, and care. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?